to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think we learn a lot by China's response. Around the globe, every country is prepared for U.S. tariffs, and they are prepared to retaliate. And they have been planning their retaliation to do the maximum damage on the U.S. and the minimum on their economies.
Pricing from Mexico and Canada, once that was relieved by the deals that were made with the two countries, obviously took some of the upside pressure off of prices. And I think some of the traders were quite caught long. They didn't think that these tariff threats would disappear so quickly from the northern and southern borders, and I think there's a little bit of bailing on long positions in oil, and we're seeing now prices moderate back to $70.
There was this notion that Bitcoin and other cryptocurrencies might be a hedge against inflation, against market uncertainty. But it's turning out to be the case that Bitcoin is behaving just like any other risky asset. In fact, given that there isn't any clear intrinsic value which would allow for a valuation model to pin down the price of Bitcoin, it's acting like an even riskier asset than any other. So it goes up and down with the market, except that it goes up and down a lot more.
We got 1 hour to go until the market close. So let's take a look at the major averages. They are up today despite the retaliatory tariffs that China put on, being seen by some market participants as perhaps not full throttle, right? Just sort of a more tepid response. The Dow higher today by 126 points or so, about 1/4%. The S&P 500 up about 2/3%, and the Nasdaq up about 1.2%. One area of the market where I do want to point out, we are seeing a more clear response. There are two companies specifically that were named as being added to a blacklist from China. It's not exactly clear why, and it's not exactly clear what the implications will be, but PVH and Illumina, in two very different industries, by the way, are both falling today because of that new designation, if you will. Illumina right now down about 6%. PVH, the clothing maker, down as well on the day, and down sharply over the past 2 days after earnings.
Yeah, it's interesting because you have these individual movers which are in the red today, but overall, as you noted, buyers have stepped in. Despite the noise and the headlines, there is green all over your screen. And there's a few reasons. One is, obviously investors are going through a lot of earnings. Some of the earnings we talked about yesterday, Julie, are still very much in focus. Palantir is surging in today's trade. It's up more than 20% last I checked. You have other big names after the bell today. You got Alphabet, you got AMD, and we have actually Dan Ives on deck. He's going to talk through all things tech with us. And then you mentioned tariffs too, and it's interesting there because there is a lot of hot talk. And so you kind of question, what are investors kind of thinking here? Are they thinking, despite all those headlines, maybe actually the actual impact will be more modest, or do we actually even see them enforced? Is it more just one giant negotiating strategy? Craig Johnson over at Piper, I thought, obviously a technician, I thought his take was interesting too. He was saying, listen, you've certainly seen more uncertainty, but as a technician, as a chartist, he's watching those popular averages that we talk about every day, and he still say, listen, they're in still well-defined uptrends. His point being, you've seen these short-term jitters about trade wars.
Right.
It was about DeepSeek, but so far, Craig's point is they've actually proved to be good short-term buying opportunities.
Right, that has been the case. We'll see if that remains the case. Something else I just want to explore for another moment, linger on another moment, is that big cap tech trade. Because as you mentioned, we got Alphabet after the close today. The shares are trading higher by 2%, even though it was also enmeshed in the China situation. China said it was opening an antitrust investigation.
Monopoly probe.
Right, although Alphabet doesn't really even operate in China and hasn't for a long time. So again, that's sort of a muted response, if you will. NVIDIA, also, there's some concern about, are there going to be increased chip export controls retaliatory affecting NVIDIA? The shares are up almost 2%. And then just want to point out the monster move that we've seen in Meta. So here is the intraday chart here. Well, let's take it to 1 month chart, if you will. This streak that we have seen, if I can write on this chart here, I won't. The streak is 12 sessions, which is the longest winning streak ever for Meta shares. So definitely you've seen.
And one other name drop I point out, you
Yeah.
see Apple popping about 2% today.
You can touch it. It
That's
won't bite
another name.
you.
I don't want to mess with the screen. That's too much. That's too. I can't multitask like that. But I would say it is interesting that on the street they were talking about what would China tariffs mean for Tim
Right.
Cook's company if they were enforced, if Cook's company didn't get an exemption. So far, for example, the team in Evercore telling their clients they would not actually expect a meaningful impact. We'll see how it
There you
shakes
go,
out.
and the shares are up.
For more on all the latest market action as stocks all rebound today, let's welcome in now Venu Krishna, Barclays Head of U.S. Equity Strategy. Venu, it is good to see you. So let's start with tariffs. I'm curious, I would imagine, Venu, you're getting plenty of questions from clients. They're wondering all these headlines. What do tariffs, what do they mean? What could they mean for the economy, for the markets? You're telling them what, Venu?
Well, one thing we're saying is that it's been very confusing to see whether the president was serious or is he, does he really mean it, and how seriously are we supposed to take it? And I think now it is becoming more and more clear that he is indeed going to be pretty aggressive on tariffs. So how it plays out is difficult, but what we try to do is what we can control, right? Which is trying to estimate for overall S&P what the impact is. So if you look at the latest measures, 25% on Canada and Mexico, 10% on China across the board, and if you assume that they also retaliate, just like most of them have announced they will, then our estimate is that the earnings hit to S&P this year will be about 3.5% to 4%. So not a trivial number, but quite a significant number.
Venu, that are more at risk than others to that?
Absolutely. So you have energy, you have materials, and you have discretionary. And within discretionary, you have autos, for example, significant amount of exposure. And that's why you saw GM react very negatively yesterday before the sort of halt was imposed on the sanctions against or the tariffs on Mexico. So absolutely, I think it varies from sector to sector. These three are the most exposed. The earnings hit can start touching high single digit, double digits in these areas. And so I think you have to step back and think about what portion of this is real, what portion of this will be sustained over a long period of time. So if the tariffs come in and go out after this year, it's a one-time hit. But if you're living in a world in which they're looking at tariffs as a source of revenue, potentially to address deficits, right? People have talked about that. Sounds pretty wild, which means then this is more permanent than what you can think of. At a time when S&P earnings, even the consensus estimates, which are talking about outside of tech, growing about 12%, we think it's closer to 4%. That's a pretty big number.
Yeah, and there you break down in a recent note the exact amount. You're talking about a 2.1% hit if the tariffs go into effect, and then 1.6% hit from the retaliatory tariffs.
That's right.
So all of that said, we were talking earlier about whether the market has priced this in, and this sort of process of back and forth. Are they happening? Aren't they happening? What do you think? What has the market priced in at this point?
Yeah, if you take a step back, actually, ever since the election, I would argue that the market has been disproportionately pricing the good news. That is the pro-growth policies like deregulation, things like that, and the tax cuts potentially are being priced quite optimistically. What is not being priced is the impact of a more aggressive stance on immigration and a more aggressive stance on tariffs. Because if you talk to majority of the economists, the view is that these two, tariffs and immigration, on the margin are definitely more inflationary and will have a negative impact on growth. The question is, if that happens, then to what extent is that buffer to some extent for the pro-growth policies? Do they even out, or which wins out? That is the question.
Well, what do you think? Do you think that the risks are tilting to the downside now? Are there, where we are, the levels where we are in the major averages right now, are they dangerous levels? Are they risky levels, given that outlook?
They're not dangerous, because I think one good news about entering this year is we actually, despite all this noise, expect earnings to accelerate this year. So last year we saw aggregate earnings of around 9%. This year we expect earnings to around 12%. The consensus is a little higher, closer to about 13%. So the good news is that it is indeed high. I think the problem for this market is on the valuation front, where I'm not arguing it's rich, but it's quite fully valued. So what does it mean? That if we have any negative catalyst, before this whole tariff noise, we thought the negative catalyst is going to come from interest rates. right? So as interest rates start creeping up, the 10-year, then historically at least, there is a very clear negative correlation which kicks in. In other words, 10 years going up and equity is falling around the 5% threshold. But already the negative correlation is in place. You saw that when 10s went to almost 4.8, the market reacting negatively. What we did not foresee was this DeepSeek news more recently, which I would argue is sort of more fundamental. So what that is doing is putting a laser focus on the scale of capital spending by big tech, which has been the fulcrum of this market in terms of earnings and returns as well. Last 2 years, more than 50% of S&P returns have come from big tech, which is a small group of 6 stocks effectively.
And it sounds, Venu, like they, though, on that point, we heard from a couple of them already, we'll hear from Alphabet after the close today. It sounds like so far, you listen to Zuckerberg, for example, they intend to just keep spending. He sounded enthusiastic about AI infrastructure spend.
Yeah, but I think, you know what, I think by the second half of the year, it already happened. 6 months ago, actually, is when the market started focusing more on the scale of capital spending and getting a little worried. And if you're looking at big tech multiples, remember the peak multiple last year was 34. We started the year at 30. During last week's sell-off, it went to 29. Not a lot, but it did react. So I think right now, everybody knows they're committed, at least for 25. 26, I think, is still a question mark. The market wants to see the growth of applications very fast and their ability to monetize. Right now, for about 100 billion of CapEx, the realized revenues are only about 5 odd billion. So it is minuscule, right? But if one good news on the DeepSeek information is if the cost of actually using AI comes down and its applications which take off, that is ultimately the use case of AI. That is what everybody wants, seeing productivity enhancements and having a big impact. So I think it's a double-edged sword. So it is a little bit of wait and see. Probably for this year, you're right. I don't think they're going to cut their CapEx. But at some point, I think patience will run thin in terms of, shows the monetization effect of all this.
Yeah, at some point. We'll find out when that point is.
That's right.
Venu, thank you so much for coming in. It's great to see you.
You're welcome.
Thank you.
Thank you.
We're just getting started here on Market Domination. Coming up, Alphabet and AMD headline another round of earnings reports set to drop after the close today. We're going to preview what to watch from the tech giants on the other side. Stick around, much more Market Domination still to come. It's another big day for big tech. We'll be getting earnings reports from Google parent Alphabet and AMD after the close today. And who better to preview what to expect from the tech titans than our very own tech editor, Dan Halley, with us in studio. Wow, we got some strong beard game between the two y'all today.
I'm losing ground.
Hallie destroys me. It's not even close.
It's not true.
It's not for lack of effort, by the way. I'm giving it all I got. But Hallie's just, it's
A lot of, I put a lot of Rogaine in there just to really.
All right. Let's talk about Alphabet, gentlemen. So tell us what we should be focusing on specifically.
So yeah, we're looking at obviously kind of a few things. Number one is obviously the news of the day here being that China's launching an antitrust probe into Google. It's gotten a lot of news, but really as far as Google's bottom line goes, Alphabet's bottom line, it's not going to be a big deal. They don't really do much business in China. Basically, all they do in China is try to ensure that advertisers in China can get access to third countries outside. And so that's not really going to be that big of a deal, though hopefully mentioned it on the earnings call. I think really what it's going to come down to is, excuse me, DeepSeek's, what they have to say about that. We saw that Meta obviously beat on earnings. They didn't provide full year guidance, but they did explain that, the spending is going to be higher. They had projected that, though, previously, saying $65 billion this year in AI spending. So they did also talk about Meta, how DeepSeek's could be beneficial to them. And so that might be something that Alphabet, Google, Sundar Pichai could kind of come out and say, look, this is a good thing. It'll raise all boats. Cheaper models is good. We are building out that infrastructure. We have to build out that infrastructure. Also, doing that ensures better results for models like the one that DeepSeek has made. So basically, it could just be, look, this is something that's going to naturally happen in the industry, and it's going to be beneficial to us. So that's really what we're looking at as far as Alphabet goes. Then, obviously, the cloud side, that's going to be very important. In addition to the advertising side, cloud revenue is expected to be $12.1 billion compared to the $9.1 billion last year. And then the second company that's going to report, we'll talk about AMD, and they've been a laggard compared to the likes of NVIDIA, though I feel like everybody would be. Looking great compared to Intel, though. So, that's not saying much, though. For the quarter, we're expecting to see earnings per share of $1.09 on revenue of $7.5 billion. Data center is their biggest business. That's expected to come in at $4.09 billion. That would be up from $2.28 billion the same time last year. And then the client segment, this has been a real issue for AMD as well as Intel. The client segment's going to come in at $1.98 billion versus last year where it was $1.36 billion. The issue here is that PC sales have just kind of lagged. There's been, I think, IDC or Gartner had said it's like a 1% increase year over year from 2023 to 2024. There's supposed to be this whole big push for AI PCs. It's not taking off yet. That doesn't mean it's not. In October, Microsoft is going to sunset Windows 10 security updates. And so that means there's going to be a whole enterprise group of customers that's going to come in and say, we need new laptops because we can't have unsecured systems. And so that could be a boon for AMD and Intel as well. And as far as gaming goes, that's become their kind of baby segment, we'll call it. That's expected to be $487 million for the quarter, down from $1.36 billion. Part of that's custom gaming chips and then gaming cards for PCs as well.
A lot to look forward to. You're
Gonna
going to be very busy.
I got my extra large Dunkin'. I'm
we know
flying.
how you prep. All right, thanks, Dan Halley. Appreciate it. Well, Palantir reporting a convincing beat on fourth quarter earnings. Our next guest says the tech giant is playing chess in the AI arms race while others are playing checkers. Joining us now, Dan Ives, Managing Director and Global Head of Technology Research at Wedbush Securities. I don't know which analogy to pick. They're the Messi of AI. They're playing. I'm picturing like Messi playing chess.
I like that.
Against maybe some other entire team playing checkers. I don't know. Yeah.
No, I like that. I think that's a great one.
You have my permission to put that in your next.
I will. I could cite you.
So why do you think Palantir, in your view, I mean, you have said consistently that they are way ahead. Mm-hmm. What do you think is the sort of special sauce?
Look, I think Karp and the team at Palantir, they have built a unique product that I think is unmatched. When it comes,
what makes it so unique?
When it comes to any customer, literally the 50 or 60 customers that we've talked to, No one matches Palantir. They could come in here and basically do a data dump for a day and come out and be like, these are the 3 to 4 use cases that you should do here. And there's no other company out there that offers that. And that's why Microsoft's partnering with them, Oracle's partnering with them. But if you look at that earnings last night, and I would only, outside of NVIDIA, there's really been none that's been such a jaw dropper relative to what they posted from a revenue, commercial growth, as well as guidance. That's why we always say, like, the bears, they hated at 12, despised it at 50, and 100, they're screaming, from the top of the buildings because remember, the bears, they can see AI in the spreadsheets.
Let me ask you this, Dan. The bears, here's one. RBC's Rishi Jaluria, smart guy. I've known Rishi a long time. Not a fan of Palantir. So here, what does a bear say? Okay, here's what he told his clients. He said, our concerns about the runway for growth and product differentiation remain. And he goes on to say, we continue to see the risk-reward skewing unfavorable with shares trading at a premium multiple. You say what to Rishi?
I say that would be the equivalent of an NFL scout being at the 2000 Combine, seeing Tom Brady and be like, this guy, undraftable. So a 6th round, Michigan. And then 5 years later, after a few Super Bowls, this is overdone. And then a few more Super Bowls. And now so my view is, look, haters are going to hate. The reality is when you do the due diligence and you understand what they're doing, I believe this could be the next Oracle or Salesforce. I mean, that's my view relative to where Palantir is going to be over the next 3, 4, 5 years. And I think it's so institutionally hated. I think in a lot of ways similar to Tesla. But yet I think CARP on that Mount Rushmore.
So let me ask you, if it's not valuation, your clients at Wedbush, they said, okay, Dan, but what's the risk? What's the risk here I need to think about on my radar? You tell them what?
The risk I always tell them is like, look, execution, okay, they have so much demand. Quarter to quarter, they got to continue to execute, and some of those deals could push left to right, but ultimately their pipeline, their opportunity, and the street's basically underestimating it over the long term, over the next 2, 3, 4 years, by 50, 60%. I mean, I think it's that big because I think when you look at it, this is a company that I could see doing 8, 10 billion a year annually. But again, that's going to take time, but no different than, as you know well, if you valued every transformational tech name over the last 20 years, just on 1 year numbers, you would have missed from Meta to Amazon to Google to Tesla and everyone else.
I want to widen this out a little bit because I want to zero in on something that Venu Krishna of Barclays just told us a few moments ago. We were talking about the CapEx cycle of all of these companies that are throwing so much money at AI data center infrastructure build out, right? We're going to hear from Alphabet in a little bit. They're probably going to repeat that. He said, you've got $100 billion that's been spent and they're collecting up to this point something like $5 billion in profit or in revenue from this stuff. And he said, everybody's waiting for the sort of killer apps to come out. Where are we in that, Dan Ives? I mean, you pay attention all day long to this stuff. Where are we in that? When are we going to get to that point? And is there a point at which investor patience is going to run out to get there?
I think Palantir showed it last night. I think you've seen it in Salesforce. ServiceNow has shown it. I think Oracle Components has shown it. And I believe 2025, if we sit here a year from now, we're going to look back. It's the year of software. From an AI perspective, second, third derivatives playing out. And that CapEx, that's $2 trillion of AI CapEx over the next 3 years. Software is going to play a huge role. But the monetization is starting to happen. And I think that is fundamentally at the core. That's why names like Palantir are so important in the broader view. We talk about DeepSeek and everything that's happened, but the reality is NVIDIA, obviously Godfather AI, and Jensen, that's really the foundation. But the most important, I'd say most important earnings potentially during earnings season was Palantir, because it shows the use cases are exploding.
Let me ask you, switch gears, I want to get your take on Apple. Specifically, if I'm an Apple investor, I'm listening right now, I want to know what could be the impact of China tariffs on Tim Cook's company. Big deal, no deal, how do you think about it? Assuming they're enforced and Cook doesn't get an exemption.
Well, and we do believe he ultimately does get an exemption. I mean, our view is he gets an exemption just like 18, and it goes back to Cook, 10% politician, 90% CEO, and it's sort of their ability to sort of navigate these tariffs is always going to be an issue. But also it's at a point where China is so important relative to Apple Intelligence rolling out.
Well, what's the risk to that, to the
Okay.
timeline for Apple Intelligence?
So that's a great I believe that whether it's Baidu, Tencent, potentially there's a few others, that gets announced in the next 4 to 6 weeks in terms of the actual partner in China. Then that gets rolled out in April. And our whole view of Apple's product cycle is this is going to be an elongated, massive product cycle, super cycle, however you want to characterize it, but the consumer AI revolution is going to come through Cupertino. 25% of consumers in the world, when they access AI, it's going to come through an Apple device.
Well, okay, so hang on for a second. Getting back to China and that AI partner, do you think that that process, though, will be delayed or affected at all by this trade war?
I don't believe it will. I mean, based on everything, and we'll be in Asia for the next few weeks, I think this is one where the partner is going to be key to rolling it out. I think they're very, very heavily along that line to get that out. But look, it's complex, but I think that's also why Apple has been down. It's why NVIDIA is, there's just worries about overall China tariffs, but I think bark's going to be worse than bite.
He, is interesting. I spoke to Apple CFO Kevin Parekh, and Kevin said, he absolutely emphasized to me, Apple Intelligence is driving upgrades. For sure. So your bottom line is, when you're talking to your client, you're saying, listen, when Chinese regulators greenlight Apple Intelligence, you're confident, listen, that drives demand over there.
That will be that'll be the start of this massive growth cycle. Because think about it, that was 11% decline in China. It's really 5% with inventory. Now, ultimately, that starts to be double-digit growth. And I think that's ultimately going to be the key. And that's why, look, this is one where Apple, it's not going to happen overnight. It's not NVIDIA. It's not Palantir. But it comes down to install base. That grew 7% from a device perspective, biggest upgrades they had in any quarter. And I think this is one that's going to prove itself out over this year.
Dan, always great to see you. On set, by the way. Dan Ives.
This has made our day.
Yeah, no.
I mean, it's made my day being on set here.
Always great to have you, Dan. Appreciate it. Thank you, sir. Coming up, shares of Fox jumping today as the company plans to roll out its own streaming service by the end of the year. We're going to get you the details and check in on a few other trending tickers on the other side. And a final thanks to Dan Ives and his always on point, look at that, on point shoe game. You can't fake that style, Joel. You have it or you don't. You know what I mean?
I mean, look, I mean, it's your world, we all pay rent.
Thank you, Dan. Great to see you, my friend.
Now time for some of today's trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, we got to look at shares of Fox. The company plans to roll out its own streaming service by the end of the year. Our own Ali Canal joins us now with details. And Ali, they also came out with numbers, right?
Yeah, they came out with the numbers, and those numbers were good, boosted by political spending. Also saw a very strong live sports slate, so that all helped boost results in the quarter. But this was an interesting development that we got. Another streaming service, Julie. I mean, are you ready for it?
No.
Are you ready for it, Josh?
Sports and news, right? Isn't that it?
Probably. We don't have too many details. Fox CEO Lachlan Murdoch, he made the announcement during the company's earnings call. He said that while the traditional cable bundle still represents the most value for both Fox's customers and its business, the company still wants to meet consumers where they are. Now, historically, analysts have said that Fox's assets have been heavily skewed toward the linear pay TV ecosystem, which isn't great when you have a lot of folks cutting the cable cord. And to that point, Murdoch said that the new service is going to target the cord cutters and the cord nevers. Like I said, not too many details at this point, but the company does plan to release more details in the coming months. Now, Fox is not the only legacy media giant that's tried to adapt to this new normal. Recently heard from CNN parent company Warner Brothers Discovery, which will invest $70 million into a digital revamp of its network, which also includes the launch of its own streaming product. And then, of course, this all comes after the abrupt dismantlement of Venue Sports, which was the joint sports streaming service between Fox, WBD, and Disney that ultimately was abandoned due to some of those regulatory concerns. So point is, if you're a traditional broadcaster and you're not in streaming, you better get in the game. Management at Fox has clearly been hinting that this is something they want to do, but they want to target a completely new cohort of users. They don't want to convert those traditional TV subscribers. Again, cord cutters, cord nevers. So I'm curious what the price point will be, what the content will be like, and really how it's going to fit into this competitive ecosystem.
And sticking with streaming, Ali, Disney earnings on deck. What do we expect with that report?
Tomorrow morning. So I think the focus here is going to be on streaming and parks. We do know that the parks business is going to see some uncertainty, some bumpiness after those two back-to-back hurricanes that we saw last year. Disney had already forecasted a hit of about $130 million in the quarter because of those hurricanes. The Disney Cruise Line pre-launches, that's going to tack on an additional $90 million, but still over the long term, Disney had said that operating income at the park side of the business, that's going to come in between 6 and 8% full year 2025. So parks going to be a focus. Streaming also a focus. We're going to see if Disney can keep up some of that momentum. They've had a lot of recent successes on the content side at the box office. In its latest results, the company reported a streaming profit of $321 million for the 3 months ending September 28th. And really, we know that achieving consistent profits in streaming, that's one of the big focus points for investors and one of the biggest hurdles for a lot of these companies. So any guidance on that on the call, we do know that they're going to merge their Hulu live TV business with Fubo TV. I'm sure that's going to be a question mark when it comes to the future economics of that deal. So a lot to look forward here, but I'm not sure what's going to be the biggest thing that investors are going to hold on to for this one.
We shall soon find out, Ali. Thank you. Exactly. Appreciate it. Meanwhile, Ferrari reporting a fourth quarter earnings beat, helping drive shares higher. Car makers adjusted EBITDA, also topping expectations. And Yahoo Finance Pras Submarine joins with more. They still like Ferraris in the U.S. I think that was one big takeaway, it seems like.
Yeah, a quarter of the sales in this country, it's still a big, and for California, it's one of the cars they had. So, yeah, beat on top and bottom lines here, very strong. Full year results as well, and leading to 2025 guidance hike. So we saw that too. That's sort of what investors are cheering here. Did some back of the hand math here, and it's around $115,000 profit per car, right? So it's a pretty good business to be in. When your car costs $500,000 on average, you can see where that money comes in. So, projecting almost 40% EBITDA margin, which is the cream of the crop, the envy of the automaker scene. But, look, the company makes only 12,000 cars a year, right? So it's a small volume automaker, but you make that much profit per car, you can see why it's a good business, and that's what's being reflected here in that stock price.
And then we got to ask you about a report also that's coming out about Honda and Nissan. And I guess there's some speculation about they might merge, but there's some reporting that maybe they won't. So what do we know about that, if anything?
I think a report out of Japan talking about how there's some issues with, is there enough cost cutting on the Nissan end for Honda to be acceptable of the deal? Honda talked about Nissan being a subsidiary, and Nissan was not happy about that. So I think that there's some broader cultural issues between the two companies, both with very strong cultures, not wanting to sort of lose that. And I think maybe that's what's happening here, is that there's an unraveling potentially of this deal. We'll see, it's still in the works, but it seemed to me it was a huge deal when it came out. It was a big deal. This is like GM and Ford merging. But you can imagine they both have their own cultures. To bring them together, I think that's the problem.
Yeah, challenging. But the shares in U.S. trading did react when we got that report, so we'll keep watching what happens there. Well, the tariff battle between the U.S., Canada, and Mexico is delayed for now, but the implications could have wide-ranging effects on the global economy. Joining us now is Seth Carpenter, Morgan Stanley Chief Global Economist. Seth, it is always fantastic to see you. And even though the trade war has been delayed with Canada and Mexico, it has not been with China, right? We just imposed 10% tariffs. They in turn named 80 products to impose tariffs on. So how are you thinking through the potential economic effects, especially when there is so sort of stop and start and back and forth?
Very cautiously is the short answer. Just for Monday's Open, we tried to put together a piece with a bunch of colleagues here in research laying out different scenarios for the potential trade war with Canada and Mexico, because it was clear that it was not clear how things are going to turn out. So we said, there is a version of the world where we don't even get the tariffs. They get announced, but then at the last minute, maybe they get pulled. Not sure if we're in that camp yet. Things were kicked down the road for about a month. But then we said maybe there's another version where they do come in now and then they get pulled later. And then there's a third one where everything goes in all at once. I think that's the way everyone, especially in markets, have to think. You have to think about different scenarios. Now, here we've said, very hard to know for sure, but the tariffs on Canada and Mexico that were announced probably take off something like a percentage point off of growth this year for GDP, but that's a bit of a guess. We have not seen this sort of trade war against such important trading partners like Canada and Mexico, particularly when you think about the auto industry where parts go back and forth and back and forth. So exactly how it plays out is uncertain. We tried to sketch out a few scenarios.
Seth, I'm curious, as an economist, how you think through the question of whether the tariffs will be inflationary, because it would seem to me that you have to take into account, you got to model really like a host of different variables. Strong dollar, you've got to think through, okay, how much can importers absorb? How do you think through that as an economist? How do you try to model that?
Absolutely. It's very tricky. I think you've labeled a bunch of the key considerations. The FX offset, I think, is really important. Now, we work very closely as economists with our colleagues in FX strategy to try to come up with a coherent view. And we've, a bunch of the increase in the value of the dollar, I think, has already been there in the price. And so the question is, would there be that much more? So we have to make an assumption there, one of the many ways in which we could be wrong. The offset by the importers is one of the other margins that you listed. The margin compression potentially for exports is another. So we tried to make our best guess. We have our colleagues in equity strategy, our equity research, who are doing the single names, where we talk to them about where pricing power is. And then we do have, don't forget, the example of 2017, 2018, 2019. When then President Trump put 25% tariffs on imports from China, and you get a picture there as well as a cross check for what we've assumed. So the bottom line, though, tariffs do seem to push up prices, and you get a burst of inflation, probably something like 2 to 3 months after the tariffs are put on. But they also are a hit on economic growth, and that comes in maybe 2 to 3 quarters after the tariffs are put in.
So Seth, being that you're a global economist, when you look at all of the players here, when you look at the US, Canada, Mexico, China, potentially the EU, which economy is in the most delicate position? Which stands to lose the most if tariffs are indeed imposed by the US and then get into a trade war?
So very good question, and difficult to know for sure. One of the things we have published is our view is had the U.S. gone through, had President Trump gone through with the 25% tariffs on both Canada and Mexico, probably would have been sufficient to put the Mexican economy into recession. And then an economy like Mexico has extra complications. So their currency is a bit more susceptible to fluctuations, and they import a lot more. They import a lot of inflation. So weakening currency is bad for their inflation. And at the same time, if the central bank has to look at the currency and raise real interest rates in order to defend the currency, that's going to be even worse for their domestic growth. So you put those factors together, and I think an open economy, an emerging market economy with a globally traded exchange rate like Mexico, they really are at risk here.
Seth, it's interesting when you listen to the president. President Trump speak about tariffs, he often seems to focus a lot on trade deficits. He talks about that a lot. It's clearly a focus for him. I'm just curious, as an economist, what do you make of that focus? What do you make of the attention he puts on trade deficits, the different puts and takes there, in your opinion?
No, I think that's a great question. I would say across the economics profession, generically speaking, I would say economists think that kind of very, very narrow focus on just a trade deficit in the exclusion of other considerations is probably not the best metric for what's going on. Trade deficit means we're buying more from that country than they are buying from us, and I think that's pretty clear. But at the same time, someone has to finance that trade deficit, and part of what's going on there is an accumulation of our debt instruments. And so I think there's the interconnection that matters a lot. But bilateral trade deficits are also, I think, much too narrow, because you could have a bilateral trade deficit with one economy, you could have a partial surplus with another. The trade around the world could be efficient from the perspective of producers. And so focusing narrowly bilaterally is probably missing the forest for the trees, so to speak.
Well, and Seth, I also want to ask you, I guess, a little bit more long-term, leaving aside some of the policy and geopolitical goals that President Trump is trying to achieve with these tariffs, and focusing more on sort of protecting markets for U.S. products, as well as trying to bring back manufacturing to the U.S. I guess I have a two-part question. One, how long would that, in theory, take? And two, is that a realistic and good, for lack of a better word, goal for the U.S. economy?
Yeah, I mean, I think that's a really difficult proposition to call for a few reasons. First, if we go back, like I said, the previous example of tariffs imposed on China in 2017, 18, and 19, a good chunk of what we import from China, sure, finished consumer goods. And so those tariffs are taxes on the U.S. consumer, forcing them to pay more for consumer goods. But we can't forget that a huge amount of what we import from China in particular, but other countries in general, are capital goods, intermediate goods that go into manufacturing in the U.S. So tariffs are also a tax on domestic CapEx spending, and they're a tax on domestic manufacturing. And so what we saw in 2017 was a rapid increase in manufacturing employment, increases in industrial output, and then the tariffs came in. Industrial output started to fall in the second half of 2018, fell further in 2019. Manufacturing employment that had been rising rapidly flatlined in 2018 and then started to fall in 2019. So I think the evidence is pretty clear that we can actually hurt domestic manufacturing with tariffs.
Really interesting point. Seth, always great to get time with you. Thank you so much.
Absolutely my pleasure.
Coming up, crypto chief David Sachs speaking today on how the U.S. will become, or aims to become, a leader in the digital asset ecosystem. We'll get you the details of what he said when Market Domination returns. The feud between Elon Musk and OpenAI Sam Altman back in the spotlight. At a court hearing, Musk's lawyers making the case against OpenAI's for-profit restructuring plans. Here with more on the showdown between the two tech billionaires, we've got Yahoo Finance's Alexis Keenan. So what's the latest here?
So this hearing is still ongoing, and if you remember, this is the case that was filed back in November by Musk and XAI, so his own company, against Altman, OpenAI, and Microsoft added, and about 20 subsidiaries that the nonprofit has. Now, today, though, in court in California, it's a federal district court in Oakland, Musk's lawyers were arguing for an injunction. They want the court to step in and say this conversion for OpenAI from a nonprofit, and remember, Musk donated $45 million in the early stages of this nonprofit for OpenAI. What they want to do is stop the conversion from happening to a for-profit. They say that Microsoft and OpenAI, that allowing that will cause irreparable harm to Musk, to XAI, to other AI companies, to the public at large, to investors. So they're making a big argument that there's this irreparable harm that will occur that kind of can't be unwound. Now, the judge was really skeptical of this argument. She warned the lawyers right from the get-go that it's extraordinary relief to step in and have a court start deciding corporate matters, right? So
And sorry, what is the irreparable harm that they're saying will be caused if this goes forward exactly?
So there are a number of things. One is a sort of antitrust-based claim where Musk is alleging that the companies are competing unfairly because they have, for example, interlocking directors. You had Reid Hoffman on the board at one time of OpenAI, also serving at the same time on Microsoft. You also had Dee Templeton. She is now a non-voting member of OpenAI's board, an observer, they say. And so that's one argument, that the companies aren't playing fairly, so antitrust problem there. Also, Musk is alleging that Altman is engaged in self-dealing, that at one time, at the time when Musk put in that $45 million and was a co-founder of this nonprofit, that it was agreed between the two of them and others that it would remain a nonprofit. And now, by converting it to a for-profit, Altman gets a huge payday, and Musk is saying that's unfair, and that the company and Microsoft are using Musk's funds that he donated in an improper way, in an illegal way, to then convert it into this for-profit behemoth, which, of course, now in the latest couple weeks has been valued above $300 billion. So the judge being really skeptical about the injunction. However, what was super interesting is, again, right at the start of the case, she said, but this case is not going to get dismissed out of court. I am not going to grant a motion to dismiss. Part of this case is going to go forward. It is going to go to a jury trial, and they're going to decide whether or not Musk's claims that he had this contract saying it's got to stay a for-profit, OpenAI must remain a not-for-profit, that she said there may be validity to that could be plausible, and we're going to dig in and we're going to look at the evidence and we're going to find out. So what that means is the companies aren't necessarily sailing off into a for-profit enterprise at the end of the day. Whether that can happen temporarily because maybe this injunction won't get issued, we'll see.
We will see.
Yeah.
Wow. Interesting stuff,
A lot
Alexis.
came out of
Thank
this
you.
one, yeah.
Appreciate it. All right, let's get to some other trending tickers now. As always, you can scan the QR code at the bottom of your screen to check out the trending tickers. But let's look at KKR, shall we? The company coming out with its numbers here, and in particular saw some success in its financing business here for its portfolio company and other firms. However, the shares are trading lower along with those of Apollo after its numbers, after some of their metrics missed estimates.
Yeah, it was KKR Capital Markets unit. So it was record annual fees last year, booked $1 billion of fees for 2024. Also, alternative asset managers, they're looking to make loans to companies too. Why should banks have all the fun, Julie? Bloomberg did note that transactions that drove that record, they included arranging a credit facility for CyrusOne, the data center company, advising on the IPO of warehouse firm Lineage. Adam Smith, who leads the capital markets unit, telling reporters in an interview, it is part of a broader trend, he said, we're seeing where institutional capital is increasingly flowing into the private investment grade markets and creating new ways to finance deals that would traditionally, he went on to say, financed off bank balance sheets.
But it looks like the shares are down after fourth quarter insurance operating earnings might have missed some analyst estimates. So that's why that stock is taking a little bit of a hit. Apollo, most of the numbers look pretty good here. And Apollo, as we always like to offer a disclaimer, is the parent company of Yahoo Finance. Apollo came out, net income was up by 15% here, which was ahead of estimates. The company also raised $12 billion of capital last year from its global wealth business. However, it looks like its assets under management, which rose 2.5% quarter over quarter, coming in at $751 billion. That was a little bit short of what analysts had been anticipating. It looks like that's why the shares are taking a bit of a hit. And we should mention that we will be hearing from another of the private equity giants, Blackstone. Vice Chairman and CFO Michael Che will be joining us in the 4 p.m. hour.
And just minutes ago, White House AI and crypto czar David Sachs holding a news conference with key Republican policymakers to discuss the government's U.S. digital asset policy plan. Take a look.
I've talked to many founders over the past few years, and they've told me repeatedly that the number one thing they need from Washington is regulatory clarity. They just want to know what the rules of the road are so they can abide by them. We're coming off, frankly, 4 years of arbitrary prosecution and persecution of crypto companies where the SEC wouldn't tell founders what the rules were, but then they would prosecute them. And many founders have even told me stories of being debanked personally just because they had founded a crypto company. All of this approach was driving this important technology of the future offshore, and we want to keep that innovation onshore in the U.S.
Joining us now is Yahoo Finance's David Hollerith. David, great to see you. Give us your big takeaways, David.
Josh, yeah. So last year, President Trump made a number of promises to the crypto industry. And the two biggest were, one, to establish regulatory clarity, which is sort of what Sachs is talking about in that clip you just showed. And the other one was the potential for a Bitcoin and or crypto strategic reserve. And in this press conference, both were talked about. On regulatory clarity, Sachs was joined by, as you could see in the picture, Republican senators and House members who are part of various financial committees. And they've all sort of doubled down on their approach of being aggressive in pushing, one, a stablecoin bill, so legislation around stablecoins, and then also a wider market structure bill. Now, the stablecoin bill, from what they said, from what Republican House member French Hill said, who's head of the House Financial Services Committee, is that stablecoin bill is more likely to come sooner, which is what we had expected. Also today, Senator Bill Hagerty has introduced a stablecoin bill in the Senate. And then addition to that, we also had on the strategic reserve, we had Sachs, from a question that was asked by Yahoo Finance, he had sort of answered that his working group, which the president had laid out 2 weeks back in his executive order, is indeed looking into the feasibility of such a reserve. So both those two things highlight that the new administration is full tilt on delivering on Donald Trump's biggest promises to the crypto world.
David, great to see you. Appreciate the update. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the close of the bell, including the latest earnings from AMD and Alphabet coming up. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Doing a quick check on the markets here, we see that stocks finished up near the highs of the session. The Dow up by about 133 points, about a third of 1%. The S&P 500 up about 0.7, and the Nasdaq up about 1 1/3. As we get the tariff back and forth continuing, and China imposing some retaliatory tariffs on the U.S. after the U.S. imposed an additional 10% tariffs. But many analysts saying this was not a worst case scenario. So a little bit of relief in the markets today. Now let's get it out to Jared Blicker to get you up to speed on more of the info on today's session as we await the latest earnings from Alphabet and AMD. Jared?
Thank you, Julie. Let's dial up the Wi-Fi Interactive behind me. Round of applause for the majors, plus the Russell 2000, which actually beat them all just by 2 basis points. The small cap index up by 1.37%, besting the Nasdaq and the S&P 500, and the Dow as well. By the way, the S&P 500 and the Nasdaq put in the best day in a week, and so that comes after some a pretty turbulent yesterday, where the Russell 2000 was down 4% overnight. Here is the 10-year T-note yield. It was down 3 basis points today over the last 3 months. That's the chart you're looking at. Importantly, it is off of these highs here. And in fact, it opened up at a 1 or 2 week high, and it is now closing at the low. So that's a positive development for risk markets as well. We can check on the US dollar index. That is heading in the right direction, which is down, supporting risk and global risk assets. And we can also check the gold futures. Those are closing at a record, and you can see they've really accelerated in this new year, and they're closing in on $3,000 an ounce, which is a big psychological point in the markets, and really nothing besides that. Here's the sector action for today. We have energy taking the top spot. That's XLE. That was up 2.09%. Number 2, number 3, number 4, those are the mega cap sectors. So tech, consumer discretionary, and communication services, all of those outperforming the S&P 500. And to the downside, utilities, staples, healthcare, those three, and these are defensive sectors, those were the worst off. And then financials, not a defensive sector, but that also closing in the red here. And let's check out the Nasdaq 100, which is a much nicer picture than we were looking at yesterday. Alphabet up over 2.5%. Excuse me, Apple up more than 2%. So is Tesla. So is Broadcom. To the downside, just a few names. Keurig Dr. Pepper, that's down about 4%. TTD is about 3.73%. And on that note, I'll send this green screen back to you guys.
Thank you, Jared. We got Alphabet's fourth quarter numbers just coming out here. The company coming out with revenue, excluding traffic acquisition costs. That's how we look at it. Missing estimates by a bit, $81.62 billion. The estimate for $82.82 billion. Cloud revenue in particular within that missing estimates coming in at $11.96 billion, $12.19 billion. Is what analysts had been anticipating. And the company is saying we expect to invest about $75 billion in CapEx in 2025. Now, that's interesting because we had heard some commentary that would be around $80 billion. So that coming from the company directly. So interesting to hear that it's $75 billion here. Earnings per share beating estimates by 2 cents. But you see the stock down. And this goes back, Josh, to what we have been hearing from investor after investor, that these guys are, the valuations are relatively high at this point. And so, not a lot of room for disappointment is priced in.
Yeah, a quick move down about 7% here, at least initially in the after hours. Some big questions, I think just beyond the bottom and the top here for this name is how are executives thinking about the mega AI trend and how much they've been investing in AI? I mean, DeepSeek is going to come up on this conference call. Obviously, a cheaper open source model. Should they be spending as intensely going forward? They're talking still big numbers here. I mean, expect to invest about $75 billion in CapEx in 2025. I think search will be front and center, Julie. This is still Google's bread and butter, and there are questions about just the competitive landscape with the rise in popularity of Gen AI chatbots, how much of a risk that poses. Cloud is interesting. Google Cloud revenue clocking in $11.96 billion. The street was closer to $12.2 billion. So that's going to come up with there's some puts and takes that maybe analysts didn't factor into their models. And then I would expect there will be questions about the Department of Justice, DOJ suggesting a breakup of the company. It'll be interesting how let's think about that. If they want to ask the CEO and CFO on the call about that and how investors should be thinking through it.
Yeah, one bright spot continues to be YouTube and the ad revenue there coming in at about $10.5 billion. $10.2 billion is what analysts had been anticipating, so that's something to just focus on as well. I'm looking through some of the comments from CEO Sundar Pichai in the statement here. He points out that cloud and YouTube together had an annual revenue run rate of $110 billion last year, and talks about that $75 billion in CapEx, talked about the leadership in AI and momentum across the business here. He says, we are building, testing, and launching products and models faster than ever and making significant progress in compute and driving efficiencies. Now, in addition to everything else on the call, presumably they're going to get some questions about DeepSeek and its model and what effect that is going to have on the business. You know, they got that to contend with, they got the antitrust to contend with, they have whatever that is coming at them out of China, although that doesn't seem to be, folks don't seem to think that that has as much of an impact on the business.
Yeah, this stock, remember, had a nice run, too, heading into the print. I mean, it was up about 40%. Over the past 4 months, but you're quickly dropping about 7% already in the after hours here. The focus is going to be about this Q4 revenue miss and what just explains that and what they see ahead. You would expect formal guidance, but what kind of color and commentary are they willing to give?
Yeah, exactly. So we're watching all this down. It looks like that other some of the other hyperscalers are also trading down along with Alphabet, including Amazon here, which is falling.
All right, here with more on Alphabet's fourth quarter, we have D.A. Davidson, head of technology research. That's Gil Luria. Gil, it is great to see you. So listen, this stock falling hard here, about 7% in the after hours. Give us your reaction, your response, Gil. Looks like what investors are clearly keying off here is that Q4 revenue miss, Gil.
Yeah, and the fact that it came from the cloud business, right? Google Cloud has been the star of the show and the consistent outperformer. It was gaining share up until recently. And so this is a pretty big deceleration from last quarter. Interestingly, it echoes the deceleration Microsoft Azure had. Microsoft Azure blamed the core hyperscaler business and said they got growth from AI. We'll find out what Google says, what their narrative is. Either way, that's a deceleration there as well. The search business actually did fine. And that's the one where if they ever miss in the search business, that's when people will really get worried. But the cloud is an important miss, and that's why the stock is down.
And so if we can extrapolate from Microsoft, as you said, we don't know what Alphabet is going to say, but, you know, do we see and have we been seeing elsewhere a sort of redeployment of resources towards AI, and does that have the potential to cost them in the cloud business, in the non-AI cloud business?
Well, that's what happened with Microsoft. Microsoft, in fact, was pretty clear about the fact that because they were so focused on the AI and the AI investments, and they took those resources from other businesses, they're paying the price for it now with decelerating revenue, significantly decelerating revenue in the rest of their Azure business. It's interesting to hear, we don't know yet if that's the case with Google, but if that is the case, again, there's maybe a reconsideration of the overinvestment these companies have made in the data center build out, in the AI build out. And to your point, especially in the light of new models now being 93, 97% more efficient, so 20 to 30 times more efficient, do you really need to build out your infrastructure this quickly?
So, Gil, on that point, when Alphabet tells us here they see 2025 CapEx about $75 billion, does that roughly line up, Gil, with what you were expecting to hear?
That's still very significant growth over what they'll have invested last year. So that is very aggressive growth. They haven't had a lot of time to react to Microsoft saying they're going to grow their CapEx less. They haven't had a lot of time to react to the very rapid advancements in the AI models over the last couple of weeks. So that may be an upper bound for CapEx in spite of the fact that it does represent significant growth.
So I guess the question is it too much? And if these companies start to come out and say, we don't need to spend this much, will that be good news or bad news for investors?
For investors in Microsoft, Google, Amazon, it is good news if they say they need to invest less in CapEx. If they can meet their demand without having to escalate the data center build out every year, and still get the revenue from their customers, that'll be good news. Because right now, these CapEx numbers mean cash flow is declining. They mean they're going to have a drag on margins going forward. That's why Microsoft has underperformed so much, is that their margins are under pressure from these very heightened levels of CapEx. Their cash flow declined 29% last week. If we keep seeing the same things from Google and Amazon, they're going to have to be more disciplined about CapEx as well.
Gil, final question. You have a neutral on this name, Gil. Why are you on the sidelines with Alphabet, and what would you need to see to get more bullish?
Alphabet's management is sitting on incredibly valuable assets, but it's a conglomerate. So instead of having YouTube, Waymo, the TPU and DeepMind business being separate, some of the other bets being separate, and getting their the appropriate valuation, they're bundled in with a search business that investors are just not going to pay up for. So the overall Google will continue to get search multiples even on those other exciting businesses, unless they decide to spin them out, which currently doesn't look like they have a plan to do.
It does not look that way. Gil, great to catch up with you and get your instant reaction here. Really appreciate it.
Thank you.
Coming up, we got plenty more earnings coverage still to come, including the latest results from AMD, Snap, and Chipotle. Stick around, more market domination overtime coming up. More earnings to get to. We're going to start with Snap here. Those shares jumping some 9% following fourth quarter results here. The company coming out with their earnings per share of 16 cents. That's 2 cents above estimates. And also seeing the numbers beating estimates when it comes to the revenue, $1.56 billion. Daily active users of 453 million, also ahead of estimates here. So beating on a number of different metrics. First quarter forecast for revenue of $1.33 billion to $1.36 billion. That is above the estimate of $1.33 billion, or at least lets them have some room to beat estimates. And looking at the statement from Evan Spiegel, the CEO, he talked about making significant progress on core priorities of growing the community and improving depth of engagement in 2024. Josh, the big question for Snap, of course, and for investors is what happens with TikTok?
Oh, yeah, for sure. I mean, on the call, it's always interesting. You'll hear executives talk about not just their company, but you certainly want their take on kind of the overall ad environment, of course. What kind of momentum are they seeing with Snapchat Plus? That's their subscription service. But yes, TikTok is also front and center, Julie. What if it does get shut down? Investors are trying to kind of place their bets, and Snap was seen as one of those names which could benefit, right, in that situation in terms of just eyeballs and ad dollars.
Well, it's sort of semi-shut down at the moment.
We're in limbo.
It's not accessible across the board. Yes, we're in limbo. So I guess Snap maybe is seen as half benefiting, if you will. And it looks like they did have strong subscriptions and also strong ads, and that helped drive the business.
All right, moving on. Chipotle also out with its latest quarterly earnings, and the shares are down about 3% here in the after hours. Yahoo Finance's Brooke DePalma breaks it all down for us. Brooke.
Good afternoon to you both. Wall Street a bit disappointed here after Chipotle posted in line mostly and then same-store sales miss during their fourth quarter report. Revenue, taking a closer look, came in at $2.85 billion. That was in line. Adjusted earnings per share coming in at 25 cents, also in line for the quarter. But same-store sales growth, a slight miss there. Wall Street had hoped for a jump of 5.67%. Chipotle posted a jump of 5.4%, and that was largely driven by a higher than expected average check growth of 1.4%. We know that back in December, Chipotle announced that it would reinvigorate higher prices with a 2% increase in price. Traffic growth, not what Wall Street wanted here. We know that inclement weather, and in addition to that, the lapse of their very successful limited time offerings was going to impact that, and it did in the month of December. That came in at 4% versus a 4.4% that Wall Street had expected. For the full 2024 year, results did come in line with what Wall Street had expected. Another important note within the release here is they did mention that keyword that we're talking lots about in the Mexico-U.S. trade negotiations here, and that is avocados. They did mention that in their report, their food, beverage, and packaging cost was impacted to a lesser extent by inflation across several items, including higher avocado and dairy costs. Of course, that has to do with previous supply and demand issues within the avocado space prior to any tariff negotiations. In addition to this, important to note here, this was the first outlook that the new CEO, Scott Boatwright, posted for the full fiscal year. The company now expects same-store sales to increase in the low to mid-single-digit range. That could also be disappointing investors there. Stifel analyst Chris O'Cull had said that he predicted mid-single-digit range along with the consensus estimates of 5.3%. They anticipate now a low to mid, so perhaps that might be spooking investors a bit there too.
Yeah, stock down about 4% here. Thank you, Brooke. Appreciate it. AMD just out with its fourth quarter numbers. Let's get to those right away. Q4 EPS, Julie, comes smack in line. 109. The street was at 109. Q4 revenue, $7.66 billion. That's a beat. The street was closer to $7.54 billion. Finding guidance, looking ahead, they're looking Q1 revenue forecast. They're guiding between $6.8 to $7.4 billion. Analysts were expecting $7.04 billion, Julie.
Yeah, so a little room there to beat estimates, the midpoint of that revenue forecast above what analysts have been looking for. But I am zeroing in on the data center segment, right? As we know, AMD trying to gain some ground in that business against the juggernaut that is NVIDIA. Data center revenue in the quarter, $3.9 billion. That is up 69% year over year. I did see some estimates that were a little north of $4 billion for that business. But it doesn't seem to be slowing down what we're seeing in the reaction in the shares. Also, the company said in the quarter its gaming segment revenue was $563 million. That was a decline year over year, but came in much better than had been anticipated. So just a couple of areas to highlight there. Lisa Su, the CEO, saying in the statement here, talking or highlighting, I should say, that data center segment annual revenue and that adoption has been accelerating of their EPIC processor. So again, we'll look to the call to see what kind of more commentary and color we get around that AI demand.
Yeah, remember heading into this print, this stock was actually down about 30% in the past 12 months, and you sort of compare that to NVIDIA, and the question that you zeroed in on there, Julie, is the right one, and I think investors are just wondering, where are they in the great AI data center space just now and 12 months from now? Stock now kind of bouncing all over the place. We're basically hugging the flat line. Also questions beyond the data center and the PC market. What does Lisa Su have to say about that market looking ahead? Does she think AI-enabled PCs could jump to start that market? Gaming, what kind of trends and trajectory they see there? And Trump's tariffs on Chinese goods, Chinese-made goods. Our own Dan Howley pointing out that you would not expect that to affect the majority of high-end chip market, because most of those chips are going to be made in Taiwan, for example. But how does it affect the broader electronic space, PCs and servers? They'll get questions about that as well.
Yes, most definitely. Let's get more on AMD now. Fourth quarter earnings crossing the wire moments ago. We're bringing in now Matt Bryson, Managing Director of Equity Research for Hardware at Wedbush Securities. Matt, we saw the stock pop a little bit, and then it kind of wavered. Now it's down a little bit. Do you think that data center number perhaps is to blame?
Yeah, I mean, I think that people were looking for a bit more on the data center side. Having said that, certainly expectations around what AMD might give us for an AI number in 2025 have come down significantly, I think, over the last month and a half. I think a lot of that is why AMD's been trading as poorly as it has.
And so, Matt, when you think about AMD's role here in sort of the great AI data center space, where are they now, Matt? Where do you see them 12 months from now as they compete with the NVIDIAs?
Yeah, so I think they're still the best alternative to NVIDIA. So the concern is that you have Microsoft, Google, Amazon all building their own processors, and that they'll use that for inference in their own workloads. That's where a lot of AMD's business today is, and so displacing that AMD opportunity. I still think that there's a place for an NVIDIA alternative, something that looks a lot like what NVIDIA is providing. I think that those hyperscalers, they want competition as well. And AMD is the closest thing to NVIDIA right now. And so I still think that there's a space for them. Maybe the opportunity isn't quite as large as it looked like it might be 2-3 months ago, or certainly a year ago when people were talking some really large numbers in 2024. But I still think that they have an opportunity to sell data center AI chips.
And sort of when we're talking about the hyperscalers and what they want to use, I mean, we've seen the market now also go not into just NVIDIA chips, but also custom chips, right? That these companies are having made by the likes of Broadcom, for example. Is that competition tougher for an AMD than it is for an NVIDIA? In other words, we know it's a competitive threat to NVIDIA. How does AMD fit into that?
Yeah, so that's exactly where the hyperscalers are potentially using, or where they're using this custom silicon, these ASICs, is to some extent where AMD's been having some success. So internal inference workloads. So I'm running my own software on AMD right now. That's probably the easiest place to put custom-made ASICs, because I know what my workloads look like. So I can custom build silicon to work with those requirements, where it's more difficult when, say, I'm building a cloud for others to use. I don't know what their workloads are going to look like. And so I think that's been some of the concern around AMD. At the same time, again, expectations have come down substantially. And at the end of the day, the AMD solution looks a whole lot more like the NVIDIA solution. So if I need something that's more plug and play, drop in and replace, AMD is a better choice than a custom ASIC.
Matt, from data center to PC, I'm just curious, what do you see for the PC market over the next 6-12 months for AMD? Could AI enable PCs, Matt? Do you see that jump starting the market?
I'm not so certain about AI-enabled PCs, but I think AMD has a much better competitive position than they did a year ago. So there's two things I'd point out. One, AMD has executed at the high end, so the enthusiast gaming space. Intel's had some struggles there. And so when you think about a bunch of new NVIDIA GPUs coming out, which tend to create a refresh cycle in that gaming PC space, AMD should be well positioned to take advantage of that. And those GPUs just started hitting over the last week. So I think that's really good for AMD over the next 6 months. And then the other place that AMD should have some room for share gain is on the corporate side of things. So you look back at CES, probably the most surprising announcement in my mind that came out of CES from the hardware side was Dell saying they're going to use AMD processors in their corporate PCs. That's something they haven't done before. That tells you that AMD's got an opportunity to take some share in the corporate market, which is a place where typically Intel's just dominated.
Matt, while we have you, I want to ask you about Intel specifically, and specifically some reporting out of the FT that maybe China is looking into some kind of investigation, sort of related to the tariffs that have just been imposed. Obviously Intel is in a delicate position already. How big of a risk do you think an investigation like that would be, or some kind of export controls on Intel would be?
I think the difficulty China's going to have there is their homegrown solutions aren't really competitive yet. And so if you start imposing restrictions on what Intel can import or what Chinese companies can import from Intel, there's not a whole lot of choice, right? You have AMD and not a whole lot else. So in my mind, could it end up benefiting AMD at Intel's expense? Maybe, but the struggle is, again, when you go down that path, AMD is the only alternative. So it's really hard to put an import control on something where you just can't replace it.
A different question, Matt. Trump's tariffs on Chinese-made goods. You wouldn't expect that to hit, most high-end chips. Those are being made assembled in Taiwan. But its possible impact, Matt, as you think through it for the broader electronic space, for PCs, for servers, how are you thinking through it as an analyst?
So the China tariffs from a PC server perspective, they matter a little bit less. A lot of that supply chain has been shifted. I think Mexico tariffs of 25% might have been a bit more painful there, but certainly smartphones. I think the majority of smartphones are still made in China. China's incredibly efficient at that sort of manufacturing, particularly when you think about the size of the factories that Foxconn has, for instance, working for Apple. They really haven't been able to replicate that anywhere else in the world. And so I think in the sense that those tariffs potentially add to the price of smartphones, some other consumer electronics still coming out of China, that's a bad thing for the hardware industry in general. Again, having said that, I think it would be more concerning again if we saw tariffs in Mexico or tariffs against other Southeast Asian nations. And then lastly, of course, you've had Trump talk about tariffs on semiconductors. That could be disruptive for some of the Taiwanese names. I think less so Taiwan Semi, because kind of like putting export controls on Intel, there's just not another choice for advanced chips. But certainly guys like UMC, they try to compete toe-to-toe with global foundries, and it's hard if you're being tariffed.
Matt, always great to see you and to have you on the show. Thank you, sir.
Thank you.
Time now for What to Watch Wednesday, February 5th, sponsored by Tasty Trade. Starting off on the earnings front. Earnings season is raging on, and we're in the thick of it again tomorrow. We're going to be getting reporting from Novo Nordisk, Disney, and Uber, among other names. Disney announcing results for the first quarter. That's before the opening bell. Analysts expecting operating momentum to pick up with its recent merger of Hulu Plus Live Sports and Fubo TV.
Taking a look at the Federal Reserve, we'll be getting another batch of Fed commentary tomorrow, including Chicago Fed President Austin Goolsbee. He's commenting on the Fed's cutting cycle in an interview with Marketplace. He did that yesterday, saying President Donald Trump's economic policies could slow the Fed's interest rate cutting, and inflation could start kicking up again with tariffs.
And moving over to the labor force, monthly ADP employment data is coming out in the morning. Economists forecasting that number to come in at 150,000 for January. The new data giving us more insight into the state of the labor market ahead of Friday's full jobs report.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. A bounce back day for the markets with strong earnings from Palantir helping push the Nasdaq 262 points higher on the day. We're going to dive into the rest of today's market trends. Then, as tech giants pour money into AI investments, one of the largest global investors in data centers is keeping its sights on AI demand. We're going to talk to the CFO of Blackstone about its plans for 2025. Plus, where are we in the AI cycle? It is 9 p.m. at the party, the third inning, or at the 50-yard line. I'm going to try to figure all that out. Well, Alphabet expecting to invest $75 billion in capital expenditures in 2025, much larger than what Wall Street had been expecting as tech giants pour money into investments fueling AI goals. Blackstone, being one of the largest global investors in data centers, is keeping its sights on AI demand. And here to discuss is Blackstone Vice Chairman and CFO Michael Che, along with Yahoo Finance's Julie Hyman. Michael, great to see you on set.
Nice to be here.
So let's start, Michael, with Alphabet. They just reported results after the close. Big tech is obviously very enthusiastic about spending, building out this AI infrastructure. You're a perfect person to talk to about this because you all own around $80 billion of data centers. So I'm very curious to hear just your thoughts about this theme and trend and how you see it playing out from here.
Sure. Well, the big picture is, and we started investing in data center 5 or 6 years ago, the growth in sort of data that is created and stored in the world has been about 100x over 15 years. And so this is a real mega trend irrespective of sort of current events. And so we're big believers in that. You know, our data center portfolio consists of very long-term leases, 15 to 20 years. Obviously, the counterparties are some of those valuable companies in the world with very attractive leasing economics, and all done on a pre-leased basis, not built on a speculative basis. So this has been a very valuable and robust platform that we've been able to create.
You said notwithstanding current events, but we should ask about current events, right? We should ask about DeepSeek, I think, and the sort of questions that were raised about what was seen as a more efficient, cheaper model. And then does that change the demand perspective for what's going to be needed on the data center?
I think our basic perspective is that the continuing decline of the cost of compute will lead to more usage and faster adoption, and that drives overall demand for data centers. And so I think this has been, as you I think alluded to, reinforced publicly in recent days by hyperscalers like Meta and Microsoft, who reiterated their plans for CapEx spending, as well as in industry conversations we've had. So over time there may be, I think Microsoft talked about sort of the fungibility of data center use. There may be sort of impacts on the training portion, which is actually a relatively small portion of our sort of data center estate, but with benefits to inference and with benefits to enterprise adoption, and also overall cloud use in these data centers has been growing at over 25%. So when you think about that, we remain very bullish about it. And I would also say on a long-term basis that the power of our platform, scale and incumbency is very significant. And so I think the barriers to entry will only go up to the degree there's uncertainty over time from recent events. And I think that's a positive for what we own.
So you own about $8 billion of these data centers, Michael. I'm also curious just to hear you all at Blackstone, how are you leveraging AI at this point? How is it already impacting the business and what do you see ahead?
Yeah, we think about it, Josh, at different levels. So we think about how over time it can enhance our investing process and sort of our insights and how that feeds our investment theses and how we execute on them, how we can help our portfolio companies. And so we invested a long time ago in building out a big team of data scientists. We have about 50 data scientists, and they are in the main focused on the sort of challenges and opportunities around our portfolio companies. So obviously in an AI world that has a tremendous application. And then our own operations, our own productivity and how we can use it to be more efficient over time. And it's still early days. It starts with how do you take our data, and basically integrate it, synthesize it, amass it in a proper data warehouse so that it can be utilized over time. And I would step back and say that the opportunity, I think, in AI is really going to be a function of the power of the data that you possess. And so for us, as the largest player in private markets that's been doing this for decades now, our sort of trove of data, across all these businesses, across asset classes, across geographies, and then longitudinally over time, that will be a really powerful asset for us. It is and it will be. And if you compare it to public market investing, I think it'll only reinforce sort of the advantage and the edge that private market investors have when they possess that kind of data they can leverage, proprietary data, versus public market investors who are basically, confined to investing based on data and information that is public. So, and in that sense, somewhat commoditized.
Michael, I want to widen it out, talk a little bit more about what's happening, again, to the state of the world, this current sort of tariff back and forth that we're seeing happen in Washington. And we've talked to some folks who have said, that this is perhaps going to make it more difficult for American corporations to make decisions because there is sort of back and forth. There's uncertainty about what policy is going to look like. Now, you guys have an interesting perspective because not only do you have the Blackstone perspective, you also have the portfolio company perspective. So how are you, is that happening? Are you all sitting back on certain decisions until you wait till all this plays out?
That's not quite how I would look at it. We're a couple weeks into this.
Right.
And so, in terms of our portfolio, I would say we have, when you step back, pretty limited exposure, direct exposure to where tariffs could impact most. So we have limited exposure to companies that export physical goods into the U.S. and also companies that have heavy input costs from abroad to U.S. companies. So that's a good position to be in. But look, I think it's early. This will play out. The president clearly views tariffs and the threat of them as sort of an all-purpose policy tool. If there's any doubt about that, that was dispelled in the last couple of weeks. But I think the question's really going to be sort of there's between a gradualist and sort of maximalist approach in applying them, and I think that'll depend on the goals and sort of the counterparty, which country's on the other side of the table. So I think it's too early to judge, and I think the lasting effects will be seen over time, and I don't think we'll have to react to something that plays out just in a matter of days.
Fair enough.
Michael, great to see you. Great to have you on set. Thanks for joining us.
Great to be here. Thanks.
Thank you.
Big day for earnings. Let's get to some more crossing after the close today. First up, Amgen. That stock is slipping after hours despite a fourth quarter beat on earnings, revenue, and product sales. That's due to the biopharmaceutical company revealing the phase 1 study of its new obesity drug was placed on clinical hold by the FDA. There was no reason given for that pause.
Next up, Enphase, shares of the energy technology company surging after it announced a fourth quarter beat on revenue and earnings. It also offered a first quarter revenue forecast above expectations. Enphase expects revenue for the quarter to be between $340 million and $380 million.
And finally, let's talk about Mondelez, the multinational snack food company, missing on fourth quarter revenue and earnings and seeing an adjusted EPS decrease of about 10% in its full year forecast. Stick around, much more asking for a trend right on the other side. This morning, software firm Palantir delivering stronger than expected fourth quarter results. That was largely thanks to an AI growth surge. However, last week's arrival of China's DeepSeek AI has investors in Silicon Valley alike wondering about America's place at the center of the artificial intelligence revolution and where we are in the AI cycle. Joining us now is Josh Wolf, Lux Capital co-founder and managing partner. Josh, it is great to see you, to have you on the show. So let's start there, Josh. We just had a rush of earnings after the bell here, including Alphabet. I would imagine, of course, on that conference call right now, those execs are getting a lot of questions about AI. Where do you see us, Josh, in kind of mega AI trade and trend? Where are we in this cycle, Josh? And what excites you as a venture investor? Where do you see opportunity?
Well, starting with, first of all, Josh, it's great to see you. Second, there's something actually really interesting about Alphabet and the earnings, and you just mentioned Palantir, and this to me is a sea change, and I don't think a lot of people are actually paying attention to it. Yes, they disappointed on cloud revenue and profitability, even though I think it's $12 billion in revenue and $2 billion of contribution earnings. But the thing that went unnoticed is they made a change to their policy statement. You might remember back in 2018, they said that they're not going to use AI and they're not going to be working on things involved in weapons or surveillance. And they changed that just today, which means they're looking at something like Palantir, they're looking at Microsoft, they're looking at Amazon, who have been working closely with the government and the military. And they're now effectively saying we have to work on weapon systems and surveillance. And so against the judgment of a lot of employees that were protesting Google 7 years ago, I think that's an amazing sea change. I think it's great for America. And frankly, I think it's going to be great for the company.
And why do you think they made that change now, Josh?
Well, I think that there's this tailwind of geopolitical conflict that is a reality. And it is not just sovereign versus sovereign, but we have a massive technological challenge between US and China. And I certainly would prefer that Google systems, an American company, are being used by enterprises around the world versus Chinese companies and the censorship and everything that comes with it from the Chinese Communist Party, the CCP. So I think that they see that there is a tailwind here of demand and a moral necessity to be involved in these things. And instead of kowtowing to the employees who were basically saying we don't want to be working on, I think what they said was the business of war, you might not have an interest in war or conflict, but war and conflict has an interest in you. So I think that this is an important sea change. And when you see Palantir's sales rising, combination of AI and defense focus, and unapologetic Alex Karp, who I think is a great leader and a great patriot, and Google now saying, you know what, we're not going to be a company that's the inmates running the asylum, but we're going to take leadership here. I think it's a great change. Overall, in AI, I think the hyperscalers right now are wrestling with the massive investments that they've done in some of the large foundation models, a lot of that capital back like the early 2000s with Cisco round tripping, where they would make investments in companies that in turn would go towards buying cloud credits and seeing huge investments and huge valuations for these large foundation models. With DeepSeek and the rise of open source, which we are heavily invested in particular, companies like Hugging Face as a repository, companies like Together AI, Together Compute for the distribution of computing resources, you're seeing a change in the efficiency, in the economics. And contrary to the last guest, who of course has a big interest in seeing data centers continue to build, I think that we're going to see a shift from inference away from these very large data centers onto device, and it's going to change the ecosystem with more interest and capital and talent going towards the memory players and on-device inference, and it's going to be a big shakeup in the space.
What about DeepSeek specifically, Josh? I'm interested to get your thoughts about that cheaper open source model. What do you make of it?
Well, first you have to either believe that the $5 million number is right, or you have to contest it. I don't think that it was done on $5 million. There's a lot of evidence, obviously, if you look at the first query that people did, what model are you? The answer was ChatGPT. We know that it was trained in some ways on these distillation techniques of taking from ChatGPT. A huge amount of capital went in there. So this wasn't like it was a de novo development that they were doing on just $5 million and very few GPUs. We also know that the number of reported GPUs is a real question worthy of investigation. Of course, we try to restrict their access to H100s and some of the other higher quality NVIDIA chips. But when you look at NVIDIA sales and distribution, and you've got 22 or 25% going to Singapore, an island nation, you've got Malaysia, Indonesia, some of these other countries, clearly there has been a porous movement of chips to China and some of the companies. I think that the wake-up call, though, is really one about America versus China and a talent war. Even if you look at the number of undergraduates in AI that are being graduated, 50% of the world's undergrads in AI are coming from China. 37% of the researchers in our own country are coming from China. 38%, outnumbering us here domestically by 37%. And the number of university grads that we're attracting globally from the international community used to be about 23%. Today, it's down to 15%. So to me, the bigger thing here is that this is a wake-up call about the need to compete. Cultures get what they celebrate. And if we are celebrating celebrities and Kanye West and the Kardashians, we are losing. And that is very much what our adversaries would like us to be celebrating. We need to be celebrating scientists and engineers and thinking about technology in a new frame, which is technology diplomacy. It used to be that diplomacy was military and economic and political. Now it's about technology, and we have some major opportunities to have allies in the UAE and Saudi Arabia, France, Germany, South America, and basically really take the fight to China on the technology front.
So as we look, Josh, though, there to stay ahead of China, as the U.S. looks to stay ahead of China in this great AI arms race, in terms of policy prescriptions, are you suggesting, we have to rethink education, we have to rethink immigration? What would you suggest?
Well, immigration is definitely a key thing. It's what our country was built on. I am very pro-immigration, legal immigration. Of course, we have to distinguish those things from bad actors that are coming into the country and trying to undermine us with great actors that are really trying to escape oppressive regimes and build here. We want the Einsteins coming here as they did before World War II. We want a brain drain of the best and the brightest. And as Walter Wriston said back in the day, capital goes where it's welcome and stays where it's well treated. We want the very same thing with talent. We want people coming to our shores, staying here, stapling an H-1B visa to them when they graduate with a doctorate in computer science or chemistry or physics or material science or get their PhD, and keep them here. So immigration and talent, a number one thing. Second thing, lots of reforms for the government. A lot of controversy about what Elon and the Doge team are doing. I'm optimistic that it's going to shine a spotlight of attention on a lot of excess and waste and mediocrity. But I think one of the big opportunities is make sure we are funding basic science research. And I don't mean just for the old researchers. I mean reallocating towards young researchers, people that are under 25 or 28 years old, that are full of gusto and naivete and ambition. That is where breakthroughs come from. And too many of our grants are going towards older scientists. So feed the young scientists with a lot of curiosity. That's where breakthroughs come from. Get a lot of immigrants coming here so that we can really capture talent, and do a lot of reforms, whether it's in defense acquisition or some of the other government programs, so that we can get technology companies that are young and vibrant to be able to compete with the big bureaucratic, sclerotic, slow-moving companies of yesteryear. That is what is going to make us competitive against a China that has this military-civil fusion where all of the companies are effectively part of the Chinese Communist Party and working for the government.
Josh, it was always great to see you. Thank you so much for taking the time to join us today. Appreciate it.
My pleasure.
Stick around. More Ask for a Trend right on the other side.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
All right, we're on the other side of Alphabet at AMD earnings. That means we're bringing back Yahoo Finance tech editor Dan Howley for his big takeaways.
Yeah, Josh, there's a few things here that we want to look at. Let's look at Google first. And really, the big deal here is the miss on cloud revenue. That's really impacting the stock, as well as a dramatic increase in CapEx spending. They're going from $57.9 billion to $75 billion as far as CapEx goes for the full year of 2025. They beat on the earnings per share, a little bit light on revenue, but it was the cloud that came in at let's see, 11.9 billion in revenue, falling short of the 12.1 billion that Wall Street was anticipating. Advertising revenue beat 72.4 billion versus expectations of 71.7 billion. But the other thing to look at there is cloud deceleration for Google versus the last year. So the year ago quarter, the growth was better than what we saw in this quarter. Then let's take a look at AMD. I think it's also worth noting really quick that Google is down 7% in after hours. AMD, meanwhile, also suffering after hours, down just about 5%. And there's a few things going on here. They had a good quarter. They beat on the top and bottom line. They offered a great outlook for Q1. The issue here is that cloud, again, is an issue for them, not necessarily cloud data center sales. Let's just look at the numbers here. When you go through to the let's see, data center, they came in at 3.9 billion on revenue versus expectations of 4.09 billion. So not a huge miss, and you would imagine that Q1 outlook being higher than anticipated would buoy the stock. But the reaction here from the street is obviously on the negative side. I think one of the other things to look at for them is that PC sales did rather well, 2.3 billion versus 1.98 expected, and gaming, which again is their smaller segment, 563 million versus an expectation of 487 billion. But it really is that that data center miss that seems to be doing all the damage to them in after-hours trading.
And it's interesting, Dan, because you look at AMD, they were already knocked around. They were down about 30% over the past 12 months heading into the print. I mean, you compare that to NVIDIA, for example, right? So how do you think about AMD's Lisa Su's place in the big AI data center space and market now and looking ahead? How do you think about the competitive landscape?
I think they're still obviously an incredibly competitive company. It's just that NVIDIA's kind of sucked all the oxygen out of the room. And so, AMD had a boost last year. It seems to have come back down to earth, and they're going to start rolling out new chips in this year, upgraded versions. We'll also see the same thing from NVIDIA, but if they can beat on price and offer similar capabilities, they may be able to start pulling things back up rather than this decline that they've seen over the past year.
Yeah. By the way, matching beards, matching jackets. I mean, it's like I'm looking in the mirror.
I mean,
that's what it is.
Well, my mirror is a lot better looking than the one at home, so,
Thank you, Dan. Let's take a look at what's trending after hours. Take a look at shares of Lumen popping on earnings. The telecom company reporting better than expected fourth quarter earnings. Adjusted earnings coming in at 9 cents compared to the estimate, which was a loss of nearly 5 cents, and revenue also came in above analyst estimates. Meanwhile, Mattel's fourth quarter earnings topping Wall Street's expectations, gross billings and revenue narrowly beating analyst estimates, and looking ahead, the company reporting better than expected profit guidance for the full year. Mattel also highlighting its expectation to increase investments in digital games. And finally, shares of Match, they are also under pressure. The company's fourth quarter revenue beating estimates, but first quarter guidance raising concerns for investors, which came in below estimates. Match also naming a new CEO, that's Spencer Rascoff, the founder of Zillow, will be taking over at the helm of the dating app company. Well, that's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.